You talked about your long-term play with crypto. Obviously, that's not something that you're expecting a return on. That's not factoring into your monthly cash flow, for example. What are you doing right now to move the needle on a positive cash flow month-to-month standpoint? You said you might sit on the sidelines or have encourage people to kind of that wait and see approach. I love the mindset of when there's blood in the street, I like to strike. I'm an aggressive investor, always have been. I've got a high tolerance for risk. Some people don't. Obviously, you're going to have to take a look at your own risk tolerance, risk aversion. But you said, some people might be better served to just sit and wait. You didn't prescribe to that yourself. And I can speak firsthand because you and I have started a new business within the last couple of months in spite of the uncertainties in the economic climate. So you didn't take your own advice. Why is that?
I actually disagree with you. First and foremost, the business that you're talking about is a short-term rental property management business. It's based around the philosophies that we've talked about here on the channel for quite some time. And if my memory serves me, it was almost a year and a half of sitting with Michael and Katrina regarding the B&B Bootcamp stuff. And I had said time and time again in video after video that if I lost everything tomorrow, which I'm damn well on my way to doing, the very first thing I would do is I would start doing the short-term rental arbitrage and partnership concept that they talk about. And I would pay them to show me how. Mm-hmm. And that's exactly what we've gone out and done. But it took a year and a half. So I can't necessarily say that that was done in haste. That was done after a lot of careful thinking, ways that it could be implemented in a slightly more creative approach than what they were doing. They gave us the fundamentals of that, and then we took it and brought it even to a higher level. And it's performed really, really well. I mean, we've got quite a pipeline developed already. Again, I'll throw links in the description below because we can't necessarily break down that business model in thorough detail during today's conversation. But the summarized version of it is you don't have to own the property. You don't need any of your own credit. In many cases, it doesn't take any money at all. How much money have we invested into that business collectively since December when we really started kicking it off? And January, I think, was the start of really putting time and attention into it. But how much money have we invested into that business so far?
I think we only put about $15,000 in seed capital into it.
Yeah, and how much of that $15,000 is still in the bank?
15,000. Haven't spent a nickel.
Okay,
no.
So and how much revenue has that business generated for us so far? Just ballpark.
I mean, revenues really have just started within the last 30 days. We had the ramp up period, which was really the tail end of last year. We spent the first really Q1 getting infrastructure in place, kind of getting our lead generation effort in place, developing the sales pipeline. So really 30 days, maybe 45 days into revenues right now. And we're probably 60, 70,000 in bookable revenues on that. And that's just over the next maybe 30 to 45 days. Plus, we've had multiple closings. Obviously, we participate in that in the front end closing commissions and profits on those as well. So we've developed multiple profit centers just inside the business itself in the last couple of months. But yeah, we're going to be, I mean, within the next 30 days, we will have already most likely surpassed 100K in revenue.
Great. So $100,000 in revenue. It's been 6 months and it's required nothing so far out of pocket other than basically throwing some money in the till just to sit there. Okay.
We've really bootstrapped it and just done this thing based on sweat equity.
Right. And that was because of a year and a half of contemplation and preparation. Mm-hmm. And that also came with the ability to fund things if necessary, like furnishings, like decor. If we did end up in an arbitrage situation where we actually are coming in as a tenant with permission from the landlord to sublet the property on a short-term rental platform or multiple platforms in order to keep the margin, the difference between what is generated and what is owed for the rental amount, the cost of rent, as well as the utilities and so forth. versus the partnership model, which is where we're actually teaming up with the owner, and the owner is responsible then for the furnishings and the decor, and the owner is generally going to be taking on the burden of the maintenance, and obviously they're paying the mortgage. Again, we had money available for that we had to build our way into. Some people are going to need that. They're going to need time. So I would disagree with the idea that I've moved, so quickly in certain cases that it heightened the risk for me. I think it was actually quite well thought out. The other example that I want
I don't think I wasn't saying that it wasn't well thought out. And I think the timing, it being now, I think is coincidental. This thing has been in the mix for a while, obviously doing research, that R&D component, and then obviously the rollout, has taken the last handful of months. It just happens to be landing right now where all this kind of chaos is going on. So definitely a well thought out plan. I mean, there was nothing that was a knee-jerk reaction in getting that business off the ground whatsoever.
And but I mean, to your point, you have to be able to move quickly when something appears, because not everything is sitting around waiting for you to make up your mind.
Mm-hmm.
There is the paralysis of analysis problem with certain folks, and the opportunities slip through your fingertips. Can I give you another example of an income stream that's really blowing up? Because I talked about this on the channel before, but I own this random drain business in Colorado. Okay. And I've been spending the majority of my time here in Florida right now. Colorado is home, but I bought this condo that I'm sitting in right now in December because we knew we were going to be doing a lot of work out here. Right. And a lot of our short-term property management business focus has been here in the Florida market.
Right.
So I'm not even in Colorado. And yet I own a business that requires day in and day out completion of jobs. We're going in and scoping and hydrojetting people's sewers and their septics. It is a nasty business, and that was a business. It was never like I planned on being in the number 2 game here, guys. This is just completely random, and yet here we are. You would have asked me a year and a half ago if I thought I was going to be in the industry, and I would have probably laughed. And yet, all of a sudden, the opportunity comes by, and it came relatively quickly, like you said. Sometimes this stuff just shows up. And it happened because I had been developing a relationship with a gentleman in the town that I live in back in Colorado, small town, about 3,000 people. And he had just received a cease and desist order, came frantically coming over to my house and saying, I don't know what to do. And we had actually organized a service trade. He knew that I was a specialist in finance in certain areas of money, and that, getting businesses up off the ground was something I'm good at, and he wanted help, and he offered to do all my plumbing for free on that property. Now, because I use that property as a short-term rental, that's a huge win for me to have a teammate that specializes in water issues, because we all know that one of the worst things you can encounter, especially if you're not nearby, is a problem with water. So I said, absolutely. How about I work with you? I'll spend my time with you, and I can just trust that you're basically on call if I ever need you pertaining to plumbing. And we agreed, and we'd been working together for about 6 months, and I'd been helping him with his credit, and I'd been helping him get, start targeting specific debt weapons. And he had a long way to go. He had done a lot of things wrong. And all of a sudden in December, he's frantically showing up at my door saying, I'm screwed. A competitor in town has just blown the whistle on me regarding my plumbing business, that I'm not licensed. And the state of Colorado has sent me a cease and desist. I'm out of business, effectively out of business. Poor guy has 2 kids. He's got a wife. He takes care of his mom. And I knew over that 6-month period, his goal in getting his credit up and seeking access to debt weapons was in order to get access to the equipment necessary to start doing drain work. And I had really come to love this guy. I mean, this kid, 32 years old, just the best human imaginable, great heart, and had made some mistakes, and I just saw where his eyes were on the prize, and he was just a changed person. He'd made some really dramatic transformations in his life. So I said, well, what would it look like if I made the investment? And the long and short of it is, we basically came to a 50-50 agreement on that business. I want to see if you can if you can see this.
$17,072.15. Got it.
Okay. $17,000 in earnings. It's the 13th at the time we're recording this video. Okay, based on the traction and the number of jobs that we have in the queue right now, we're on pace to have our first $45,000 month. Right now, we are currently up on last year by over 100%. We expect that by the end of this year, we'll be able to break $350,000. Last year, we did $165,000 in our first year in business, of which north of 80% of that was profit, which means that about $140,000 of that was split between the two of us. I invested into that business a total of $50,000, of which 40 grand was immediately a promissory note to the business, meaning my only seed into that business was a $10,000 investment. The full 50 came from a debt weapon. That debt weapon happened to be a home equity line of credit. I used none of my own money. I took $50,000, 10 of which was my seed and 40 was a note being repaid by the business. That's currently paid down to about 25,000 right now. And last year I made 70 grand. This year, I anticipate that number will come very, very close, if not exceeding double that amount. I just signed the paperwork today on a brand new van for the business, a $38,000 all-wheel drive Nissan cargo van. We're expanding. We spent $15,000 on equipment last week because we see where the potential in this business is after a year of trial, after a year and a half of proof of concept. Folks, that was an easy checklist for me to go through, but it required swift movement. It required preparation in advance. It required the ability to see very, very simple, logical, commonsensical green check marks like, A, this is a recession-proof business. First thing that came to mind. Well, what's going to happen if there's a downturn? People are going to need their shitters unclogged. I can promise you that much. That is not going away. Number two, artificial intelligence doesn't seem to be a real threat in this business. Somebody's going to have to show up and do the work. Number three, we're not selling sandwiches here, folks. These are expensive jobs. If you can see from that list that I was showing you, our last handful of jobs, $1,100 today, $600 yesterday, $600 yesterday, $500 the day before, $300, $600, $325, $250, $550, $2,673, $450, $600, $2,600, $300, $600, $2,473, $600, $400, $750, $800. These are big ticket items. And if we're quick about it, we knew that the market in that area was tight on competition. We know that in certain areas, these types of trades are not only important, but there are not enough people doing them. So all of these green checks were coming up as I'm evaluating swiftly to make a decision whether or not I put 50 grand into that business, because that's what's on the line to me, this $50,000. Even with a $40,000 promissory note, if the business goes under, I'm eating that. I'm personally liable for that investment. But I work the deal such that all of the equipment is owned and collateralized by me. So in the event that something fell apart early in the business, I would be able to turn around and sell it for very close, if not the full amount of what I paid for it. At that point, it'd be fairly new, if not brand new, because it wouldn't have been used if the business fell apart right away. You know, really, I would have been out only about $20,000. So I was making a $20,000 gamble, but there's been $10,000 sitting in the bank since day one that we've managed to leave in the till. We always have that $10,000 cushion. So realistically, I had about a $10,000 risk on this. Had I not been prepared with a $50,000 debt weapon, I couldn't have taken advantage of it, right? Had I not been able to just make a quick analysis of the idea behind this business, I wouldn't have been able to move quickly on it. Had I not been developing the relationship with my partner and understood who he was as a person and who I was going into business with, I wouldn't have been able to move quickly on it. So I think moving quickly, just like Usain Bolt moves very, very quickly, literally, you know, it comes from preparation. And so getting those ducks in order and continuing to do callbacks to that very first step of really getting your personal finances in a position to where you understand where you're at and you're buttoning things up, you're plugging those leaks and really minimizing unnecessary outflow in order to maximize existing cash flow with current ingredients versus having to add new ingredients allows you to add those new ingredients far more easily.
Well, yeah, I appreciate you sharing that, Matthew. So, what you did, obviously, you found an opportunity, but well before that, you positioned yourself so that when those opportunities came along, you were ready to pounce. You did that with the debt weapon that you talked about. Can you go down that rabbit hole? How did you utilize that HELOC? How'd you know about it? How'd you have that set up? How do you recommend other folks get prepared like that?
There are countless videos on this channel regarding debt weapons, folks. I'll summarize it for those of you who might be new. A debt weapon is a term that we gave to really any resource that can help you maximize your cash flow. And a lot of those happen to be lending instruments, tools you can borrow. And there's sort of this hierarchy that you'll find when exploring these available tools. Some of them we prefer, some of them we really only rely on if absolutely necessary. I can't stress enough that I think it's very important that you utilize leverage with extreme caution. And the more you can focus on tools that minimize your risk, the better. So those high interest types of tools, I would certainly encourage you to avoid right now, if not indefinitely. But yeah, home equity line of credit happens to be one of my favorites. And I like home equity lines of credit as a resource for taking advantage of opportunities because they have over many, many years come with extremely low interest rates. They're usually an interest only payment. They do happen to have a variable interest rate, which obviously you have to be careful with as well. But a home equity line of credit has complete liquidity. And that's really what we concentrate on here is being able to take that surplus of cash flow that doesn't necessarily have a purpose and slam it against our debts and really marry the two concepts between the Dave Ramsey, who believes you should never borrow even for a home, up to the other side of the spectrum, the rich dad, poor dad, Robert Kiyosaki approach of borrow, 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 and invest into speculated returns that exceed the cost of the money you're borrowing. And we've really brought those together into this powerful hybrid concept of hating debt and simultaneously loving leverage. And so the ability to overcome the contradiction inside that statement is being able to pay those debts off in record time. And that's where if I took a $50,000 debt weapon and paid it off to $25,000 in about a year, it's paid in full in 2 years. That's much faster. That is extremely accelerated from what the home equity line of credit requires from me. And it also then cuts heavily into the cost of interest of using that tool. But to my point, it's also still preserving the liquidity. Being able to take that money and apply it towards a debt weapon like a home equity line of credit. And the reason I love HELOCs is that I can just borrow against that tool again. So for those of you who have not yet pursued tapping into this, the newfound wealth tucked away inside your property and accessing a home equity line of credit that can be used when you need it, if you want it, you're making a huge mistake. And right now, based on existing values, you probably have one of the better chances of getting it, but that is going to be shifting. And as things economically change, so then do the underwriting guidelines and the response from the banks when you submit an application. So very important for people to be taking advantage of these, of getting out there and getting access to these tools immediately. So when I'm working with people one-on-one in our coaching, and again, you can check out our memberships through VIPfinancialed.com. I'm usually encouraging people go out there and get access to tools that are available to them, especially tools that don't necessarily have much, if any, expense whatsoever. My HELOC was completely free for the first year, and then I pay $150 per year as a processing fee of some kind, right? It's either $150 per year for that fee, or interest, whichever is greater. Okay. That's inexpensive. They didn't require an appraisal at the time. They didn't require title work at the time. They waived all the other fees that were involved. Literally no money out of pocket. And wouldn't you know it, I actually got the damn thing closed in just 10 days, which is one of the best experiences I've ever had with a bank. I generally tell people to expect the worst. Working with the banks sucks. I'm constantly gritting my teeth. I can't stand it. It doesn't matter how much practice I have and how many little tips and tricks I've developed over the years. I've just never enjoyed.
It's still never fun. Yeah.
It isn't.
Did
You
you go with your original lender on the HELOC?
So the home equity line of credit I got was actually through Ent Credit Union, and they have a pretty small footprint. So doing research on this is extremely important. And for those coaching members that enroll, we actually give a debt weapon cheat sheet, which is an amazing tool that actually helps them go through the process of finding and applying for the right tools for their needs anytime for the rest of their lives. So it's not a, hey, you should fish in this fishing hole, and then all of a sudden those fish are gone and that resource is no longer valuable to you. It's a, how do you find the right fishing hole to fish in? And that's really where we're helping people the most, is understanding how to identify the proper resources for those debt weapons. But home equity lines of credit are always a really important starting point, especially with the way that property values have been going for the last few years. Are there
pros and cons of going with it with your own lender versus going out and seeking a new source?
Rates and terms vary. So that's the bottom line. You're usually, my recommendation is going to be to shop it among 3 different institutions or credit unions, banks or credit unions, in order to lay them side by side. And you may have pros and cons of each, but ultimately I think the leading tool will be fairly obvious once you've compared to several providers. Usually home equity lines of credit on non-owner occupied properties or investment homes are extremely difficult to find. I'd be surprised if there were more than a small handful that are currently providing that right now.
That is super rare. Yeah.
Very, very rare. There's actually this interesting website. Let's take a look at it. I had heard about this debt weapon called Figure. It says figure out your finances in minutes. This might be an interesting one to look into as a debt weapon resource. Looks like they've got pretty good reviews, funded over $3 billion. They offer a simpler, faster way to find the loan that's right for you. Apply 100% online in minutes. They offer a home equity line of credit.
Type.
I don't think so. I think Lending Tree is more that fintech, higher interest stuff. And usually they're not fintech, any type of fintech's usually not really collateralized. I don't think Lending Tree offers home equity lines, do they?
No, they don't. Well, that's not accurate. Yeah, because I think Rocket's got a product through Lending Tree that is doing HELOCs. Could be wrong, but I'm fairly certain. I've not been on.
Well, I've had great experiences with Rocket. But here we are with this home equity line of credit. Looks like they'll lend up to $400,000, fund very quickly and in as little as 5 days. That's really rare. 5, 10, 15, 30-year fixed options. That's cool. We've got mortgages also through them. Looks like they'll do cash out refis. They'll do jumbo, and then they look like they'll do even crypto mortgages as well. So this is pretty cool. Looks like they'll collateralize your cryptocurrency portfolio. Again, you just have to be prepared for changes in the economy to influence what your lender does with you. And in the last downturn, home equity lines of credit were frozen commonly. And it was the highest combined loan to values first on down. So if you had call it 60% loan to value on your first mortgage, and you wanted to get a 30% second in the form of a home equity line of credit for a combined or CLTV, combined loan to value of 90%, that would generally be frozen, meaning the bank would cut off your access to that. You couldn't then borrow against it any longer, yet you were still responsible for the minimum payments every month. Before they would cut off an 80% combined loan to value, which would then be cut off before a 70% combined loan to value. So the less you're asking for in relation to the value of your home, the higher the likelihood that you're ongoing access to that will continue to remain available to you. And I think it's very important for people to understand. So just because it might be available today doesn't mean it'll be available tomorrow, whether you already have been approved for it or not. They can take it away from you. So use that strategically in your thought process when you're just really deciding how much you want to tap into. Because becoming greedy on that might come back and shoot you in the foot if you're really hoping to have access to it down the road and we see a 10, 20, or even 30% decline in market values across the country.
What's a good rule of thumb rate that they should be looking for? I mean, what would you consider a good rate if you were out shopping?
Good interest rate?
Yeah.
Oh, it's attached to prime, so it's irrelevant.
So prime plus.
Exactly. And prime, and it could be prime plus a half, prime plus a quarter. I mean, again, it's an adjustable rate, and it looks like obviously Figure will come in and actually offer you some fixed options, which is fine. But generally speaking, you're going to see that those lines of credit are adjustable. So I'm not as heavily focused on the rate as much as I am the terms. I want to understand what my repayment options are. Some of them have a 10-year repayment at interest only, at which point it's then reamortized over the following 20 years with the principal portion included. So your payment would obviously increase substantially after a 10-year period. Some of them offer longer or shorter than that. Some of them have higher annual fees. Some of them have more in closing costs or might require an expensive appraisal to be done. So those are the types of terms I'm laying side by side to make a decision. Usually the rates are going to be pretty comparable.
Yeah, super helpful, super helpful. And you mentioned something there. You talked about an adjustable rate, and I'm hearing some chatter that, and you mentioned earlier that the applications for ARMs are up, are more than doubled in the last year. So I guess increase in interest rates fueling a demand for ARMs again. What are your thoughts on that? I mean, last time we really heard about ARMs, we know what happened there. Things went south pretty quickly. There's some protection measures in place now. You know, they're going to really protect the borrower that they didn't previously have. What are your thoughts? Are you hearing a lot about ARMs? I mean, the fact that they've doubled year over year, I think is pretty huge.
Yeah, no kidding. Talk about that. What do you think the protections are? Are you talking about the margin or the cap?
I think both. So I think that the cap's going to be important. Obviously, you know, they're going to say it's never going to go higher than this. They're also putting, you know, in place that there can maybe be only one rate increase per year. You know, it's going to have that really 5-year window where it's fixed, and then after that, it's going to start adjusting, of course. But I'm hearing a 1 per year cap, and then obviously just an overhead cap on it as well, maybe 2 points, something to that extent. So I think it's interesting. I mean, right now with prime rates being as high as they are, you know, they're over 5%. You can get an ARM right now for that first 5-year term for just over 4%. So you can save that 1%. Obviously, it's going to have a couple factors that you're going to want to consider if you're looking at an ARM. It's going to be really how long you plan on being in the house. I mean, if you're going to be kind of in and out of that house in a 5-year or less, you know, getting that low rate now and knowing that you're going to be out of that house before the rate adjusts, I think it's a smart play. I assume you would agree.
What happens if property values come down?
Well,
what if you can't get out? What if you put 80% in, or what if you put 20% down, take out an 80% first mortgage under an adjustable rate mortgage, and property values fall by 30%?
Yeah, I mean, obviously there's going to be some risk if you're involved in an ARM there. There's not going to be an absolute fail-safe protection measure in place that I'm aware of. The goal would obviously be, if you are planning on staying in it longer than the 5 years, doing that refinance. You know, rates are going to continue to go up. We don't know what they're going to look like in 5 years, though. That's an interesting question. I mean, how do you defend against that?
I think you're probably overspending if you can't get into a 30-year fixed.
Yeah.
That would be my personal opinion. I'm a conservative person when it comes to how I go about borrowing. I like risk aversion also, even though many people have accused me of being fairly aggressive in some of my techniques and philosophies. I generally disagree with that. I, in general, believe that my techniques are a far more conservative approach than even what the most traditional concepts we've been taught would suggest we should be doing. So in my opinion, I have to suggest that people get into 30-year fixed loans and buy a property that they can afford at that interest rate.
Well, so here's a kind of a one-off. What if they're in a situation where they know that their income is going to go up dramatically within the next say within that 5-year window, let's say they're in law school, for example, let's say they're in medical school, and they know that within that, before that rate adjusts, ultimately they're going to have a massive increase in income. Would you say that that would maybe call for looking at it a little bit different?
There's always going to be there's always going to be exceptions to the rule. So I certainly can't disagree that there would be some instances where I might look at somebody's situation and say, okay, maybe this is one of those times where we don't necessarily have to follow the rule of thumb. I think that's a good example of that. There are certain people that with a fairly high level of certainty can expect that they will continue to realize, increases to earnings. Most people cannot. Most people cannot.
Yeah.
You can't. There's so much that so much luck that goes involved. I mean, and I'm in a similar position. I can say with almost total certainty, because I've bet on myself for 2.5 decades when it comes to entrepreneurship, that I'll continue to keep earning more.
Mm-hmm.
But I would not,
because you're a case study over the span of over 2 decades.
Yeah, I have a lot of proof. I have a lot of evidence to lean into on that. However, right. I still don't practice that when it comes to my borrowing. And yet, it's not that I'll never take risks with borrowing. I mean, one could argue that a $50,000 leverage used to start a hydrojetting business was a gamble in some ways, and I tried to mitigate as much of that risk as I could. On the front end, I thought about each and every worst case scenario, and it just so happened to be a $10,000 gamble I was willing to accept. Look, you're going to have to take chances.
There's no guarantees in business. If there were, everyone would be doing it. That's right.
Exactly.
Yeah.
Or in investing. So you have to determine what the reward is for the risk involved with that decision. And I'm not a huge believer that it always moves in relation. I don't think that just because your reward is high, your risk also has to be. I think a $10,000 risk with all of the variables that I was contemplating on a hydrojetting business, the risk was actually really pretty low related, in relation to the upside potential. I knew that when we were going into this, one of my prerequisites, and there's really two, but one of them is a 7-figure upside potential. It has to have at least a 7-figure potential before I'm going to entertain it. Now, I knew we couldn't do that with one location, but I knew if we were successful in one location, we could easily scale it out, especially with the specific formula that we have by focusing in small towns versus going in and competing against the Roto-Rooters in the big cities. Sure. And I liked that concept. But when I looked at it and said, hey, this upside potential is at least 7 figures, if not more, there's franchise opportunities in this, there's social media opportunities in this. There's a lot of ways we can scale this thing out. And it's going to run me 10 grand if I had to just liquidate everything tomorrow and get rid of the equipment and take the 10,000 from the till. I'm out $10,000 just covering expenses on the front end of the business getting up and running. That's a gamble I'm willing to take. That's very low risk, in my opinion, with a very high potential reward. So I'm looking for lower risk with much higher reward potential opportunities while I'm out there. But for anybody to come in and suggest that they're going to be in a risk-free environment and still build something to an extraordinary life level is pretty low odds. I mean, you're just not going to find a ton of great examples of people that have done that. You're going to find some anomalies, and you're probably not going to be one of them. I don't like banking on becoming an anomaly. I like realizing that I'm, for the most part, a dummy. I'm, for the most part, somebody that loves downtime and non-professional time as much as I love professional time. So I'm not somebody that wants to grind it out 20 hours every single day. I want, to count on other people. And I know that I'm just an average dude. And yet, therefore, I'm going to focus on areas that are just very, very commonly producing results that are, not the exception to the rule, and still succeed and have an extraordinary life.
Yeah, and I love that, you're not even looking at deals unless you can make that, 7-figure income off of it. If you're going to be involved in, in a business and trying to scale it. Same thing with us in Lavish Keys. I mean, that's an easily achievable 7-figure income for each of us in a relatively short window of time on that. So it definitely checked the box. Same thing with the drain company there, guys. Especially if you're spending time and things, and I don't know how much time you're spending on the drain company. I know that Lavish is about 5 hours,
About 5 minutes a day.
5 minutes a day. Well, that's still something, but
There's about
you're
40
generate,
hours. There's about 40 hours a week for the first 3 months.
uh,
And I usually have a rule of thumb where I want to dedicate at least full-time hours, at least for a 90-day window while systems and processes are being developed. And then we can recruit and train in order to delegate into those systems and processes. And then it becomes about great partnerships. It becomes about a great team, and it becomes about oversight, consistency with oversight, and being a good leader in those times in order to make sure that the growth continues to happen the way it should. But yeah, I mean, it was a very, very time consuming process on the front end, but over time, because of my excellent partnership and the team that we have there, have been able to really, realize a fairly high level of passivity with that business for the last year.
yeah, so a little bit more work up front. Obviously, you're in a fairly passive situation at this point. And this is just an additional stream of income for you. So, I mean, what we're always preaching here on the channel is to have multiple lines in the waters, guys. That's the best way to obviously accumulate wealth. And also, if any of them kind of fall off, if any one or two revenue streams disappear, you weren't 100% beholden to those or reliant on those to pay your bills every single month, for example. So guys, whether it's $100 a week or $1,000 a month that you can add, as additional revenue to you, find those additional revenue streams. I mean, I cannot state enough how important that is. I personally have, at any given time, 10 to 15 of those. Sometimes they come and go. Some have legs that have been around for years. Some of them I've been involved with for 20 plus years. So, and everything in between. So, any final parting shots to share on that, Matthew?
I guess the one thing I
making
would say is, just because I say a prerequisite is at least a 7-figure potential, it doesn't mean that I have the 100% expectation that I'll build to a
Sure.
7-figure plus potential. Most of my businesses have not achieved a 7-figure outcome, but they could if we continue to work the formula. But there are times where you get into something and you just don't necessarily feel as passionate about it as you otherwise would need to in order to have that 7, 8, 9-figure outcome.
Mhm.
And I honestly believe most things could grow to that extent if you really focused on concentrating on the scalability of things. But again, I have to be able to see that it can at least reach 7 figures,
Sure.
and that there's not going to be that capacity at 100K, 250K, 500K, and by shooting bigger and changing how I set goals. Because I used to set goals so small because I hated disappointing myself. And I think a lot of people do that. We just sort of, 5 million a year, come on, get real. Yeah, okay, fine. But if I'm 90% wrong, I'm still going to blow your $100,000 a year goal out of the water
Mhm.
and hit $500,000 a year.
Mhm.
And that was a lot through Brendan Bouchard, a really great influencer on YouTube. I would check him out. I just remember something that I had heard through him. I want to say that was him. That I owe credit to on that, but he really started helping me think about those bigger, hairier, more audacious goals versus being such a pussy about it, And I just want to make sure that people don't wimp out. Just really look for bigger things before you invest too much time and, God forbid, any money whatsoever on something that's going to be so mediocre that you're really not doing yourself any favors. By trying to transition from one mediocre option and perhaps a W-2 career you're not all that satisfied with into some mediocre self-employment where you work for yourself for the same or less, and you end up with all that stress and a lot more hours that you're responsible for. Because I guarantee you, most businesses do not. You cannot get off the ground for 40 hours a week. It takes a lot more work than that, and it certainly generally takes a lot more than 90 days.
Yeah, I mean, if being an entrepreneur were easy, everyone would do it. It does require hard work. It does require long hours. I mean, I vividly remember getting businesses started and I was working 60, 70, 80, 90, 100-hour weeks. I mean, consistently, but there was that light at the end of the tunnel. I knew that I wanted to be a successful business owner. And I knew that it was going to take a lot of that hard work up front so that, down the road, I was going to be able to reap the rewards of that hard work by having some more passive income streams like you talked about there. So, brother, I'm just noticing the time here right now. I've got a hard stop, so I've got to run. Look forward to catching up on the next video. I know I want to dive into the economy, what's going on there, what's going on with inflation, what's going on with interest rates. And I definitely want to chat with you about what's going on in real estate right now. I'd love to get your thoughts on that. So I will see you on the next video.
Awesome. Enjoyed it. Talk soon.
Thanks. All right. Talk soon, man. Later, bro.